Well, hello, everyone. This is Gene Trowbridge of the Trowbridge Law Group, and welcome to another episode of TLG Talks, Trowbridge Law Group Talks. And during these interviews, I'm interviewing clients of mine and other important people as far as the real estate securities industry is concerned. And today I'm excited to have a frequent client of mine on the call with me, Michael Becker. Michael's out of Dallas. His company is SPI Advisory, and you can see his website there. You might want to go to that website. It's a good example of what you can do with a website. And just inside ballpark language, Michael's does a lot of 506B offerings, so we have to be careful about what the website says and whether we're actually soliciting investors or advertising on the website. And his is a good example of what to do. So, hi there, Michael. How are you?
Gene, doing well. Thanks for having me on.
Yeah, no, I think you're doing good. You got a little COVID beard growing on your face. I haven't seen that from you in the past, so that's good. You know, in the last year I tried to draw a beard, and interestingly enough, it still comes in bright red.
Oh wow!
I tried it in college and it came in bright red, and my hair is not red anymore. So I don't know what's going on, but I shave. So anyhow. So, Michael, we've got three questions we're going to cover. Why don't you tell us how you did get in the syndication business?
Yeah, Gene. So my background really is in real estate lending. That's kind of how I got into the business. I was loaning money to other people, then kind of through that process realized I was on the wrong side of all those transactions. Kind of better to be the borrower than the lender. So went out and started buying some real estate, I guess about 10 years ago now. Started just with some small single family homes, kind of used my own money for my own account, did like 16 of those, and then just realized I wasn't very scalable. So I was kind of reflected back to what I was doing all day, every day, which was loaning on multifamily projects in Texas. So I kind of went out on my own, met my now business partner when I was a banker. He was working for a brokerage company out of Los Angeles that helped tighten it with individuals in LA and Orange County buy real estate in Texas. I made a loan to one of their clients. That's kind of how we met. So we both kind of realized we were sick of getting our bosses rich, and it was kind of going on our own. So that was 7-8 years ago, and 10,000 or so units ago of multifamily. So we've done around 10,000 apartment units. We own about 6,000 of those today. So we've gone full cycle on 4,000 or better of those units. We focus on Dallas Fort Worth, which is where I'm based, and Austin, which is where my business partner is based. So just kind of through being a vendor, kind of not too dissimilar from Eugene, kind of just working, watching other your clients get rich, and kind of realizing I can go out and do that.
Well, I did that for a long time. And my line is the care and maintenance of partners can drive you nuts or be overwhelming. The last full year that I did it, Michael, we sent out 1,676 K1s.
Yeah.
So
1,100 last year. So yeah. I'm right there with you.
I spent, 3 months licking stamps and envelopes because in my day, there were no back office companies to help us. I know you use a back office company that helps you with a lot of that stuff. And maybe if there had been one of those companies back 94, 95, when I decided to get out of the syndication business, I might have stayed in because I was at a point where I really needed to grow my business. I was selling everything through the broker dealer community, and they wanted me to do more deals and bigger deals. And I didn't want to expand. I didn't want to grow like that. So I went to law school at 45. And so all my syndication experience, just like you, Michael, your lending experience helps you immensely in putting together your syndications. And my syndication experience, I think, helps me immensely in drafting the documents for especially the first time the rookies who need mentoring. So that's great. So I've seen your presentations a few times. You and I do some live presentations together, and I know that you really concentrate and this goes to your strategy, Michael, the second question. You really concentrate on properties that are local. Didn't you grow up in Dallas?
Yep, grew up in suburban Dallas, so feel like we have a pretty good handle on the markets that we play in.
Okay. So what would you say your strategy is?
We try to be opportunistic, so it's kind of evolved a little bit over the years. We first started out, really all it was true workforce housing. So in Texas, think like 1960s, 1970s kind of year of construction. So C class, deep value add. So these deals were unrenovated, hadn't been touched, usually have some sort of deferred maintenance to them. And then we kind of graduated up from the 60s and 70s from C class to like B class. So in Texas, I think like 1980s for kind of year of construction. And then most of what we focus on now is anywhere from kind of A minus to A. So, probably something with a vintage of say 20 years or younger is most of what we look for. And that's been kind of an evolution of a couple of things, Gene. One, just kind of the way the marketplace is. We started out, you could buy a brand new Class A deal in Dallas for, around a 5 cap. B deal was like 6.5 cap, and a C deal was somewhere between 8 to 8.5 cap. Well, fast forward to today, everything's pretty much the same cap rate, whether it's workforce housing or brand new. So it doesn't make much sense for me to kind of pay the same or similar cap rates for something built in 1974 that I can for something built in 2004 or maybe even 2014. So we have now the benefit of a track record, which I didn't have when we started. So it's much easier to attract capital today relative to what it was 7-8 years ago when we first kind of getting going. Plus the market is a lot more mature today. Even in that 7-8 year period, the market is a lot more sophisticated in how people raise money and the technology, like you alluded to before, and just all those factors. We can raise, first deal we had to raise money for was about $2 million, and I didn't know how the hell we were going to get the $2 million. And last year we raised $27 million, so well more than 10x what our initial raise was. So our ability to track capital allows us to buy bigger, nicer deals. It's honestly hard for me to do, deal with 3 or 4 million in equity because the demand is, far outstrips what the availability is for that slug. So in essence, we're buying nicer, bigger stuff, and that in conjunction with just kind of the economics of it, it doesn't make as much sense for me to take that kind of renovation risk and reposition risk and execution risk for something to buy at the same or similar cap rate I can, something that's kind of already done and new and pretty. So, almost more of anything, it's just our size and our track record allows us to get favorable debt terms, which, kind of arbitrage a cap rate over interest rate. And that's really a lot of where we're finding value today, which is what I would not have thought that 70 years ago that I ever be buying kind of stuff we buy today.
Mm-hmm. Many of my other clients who do Class A, like you say, A minus and A properties, are finding that the rent collection during COVID is still pretty strong. Are you finding that?
Yeah, it's very disparate. We sold most of our workforce housing, so we have a handful left. But I would say kind of in my portfolio, it really is kind of B minus and south and B plus and north. There's a very disparate level of collections where, not that we have any material collection issues, but where they are more pronounced tend to be in the older apartment stock and the newer apartment stocks. We've had some, a little bit elevated, but, some properties are just like normal. A normal collection month kind of pre-COVID, we'd collect north of 99% of the scheduled rents, and now we're probably collecting close to 97%. Mm-hmm. And again, if you took, 2 of my properties out of my overall collections, I'd probably be closer to 98 than 97, mm-hmm. just because those are the older ones that are still kind of legacy holdovers.
Now, what your strategy is to do specific offerings. You identify the property and buy that property. In this marketplace, I'm having experienced syndicators like you with track records come to me and talk to me about a blind pool, which is, in my opinion, just simply an acquisition strategy for times when maybe there's blood in the streets. But I don't see that. I don't see that right now yet in the apartment industry. Maybe 6 months from now it'll be different, but I don't see. I'm actually talking my clients out of blind pools at the present time. What do you think about that?
Yeah, I mean, couple of thoughts. One, I think is real regional. So, I mean, I think there might be more blood on the street if you're coastal. So maybe your backyard or north of you in Northern California, or maybe you're in New York City. I would imagine the pricing in those markets are a lot more impacted than say in Texas or Florida, or Arizona, or some of the Sunbelt states. So I don't think, it's only been, relatively small time period, really last 3 or 4 months when actually transactions are going, because the first 2 months of COVID there was literally nothing going on. So really probably from June, July, when first kind of saw the first trickle of deals go, and then now kind of late summer into early fall as we record this, we're starting to see the velocity of these deals pick up quite a bit more. And pricing in Texas, I mean, honestly, it's as at the same level or stronger, to be honest with you, Gene. And what's happening is really the discounts coming in the debt, where back at the beginning of the year, these interest rates were generally kind of plus minus 4%. Now they're kind of plus minus 3%. So you're getting, 1/4 off your interest rates.
Right.
And, the stuff at 3% interest only. I mean, you can make a lot of deals work at 3% interest only. And we're seeing some of these new construction deals sized to somewhere between 75 and 80% of debt, which is crazy for me to envision that you can get, nearly 80% leverage on a brand new construction deal. That doesn't make sense. That shouldn't be the case. That's really just a function of how low the interest rates are. So what I think is about to happen, at least in the markets we play in, are cap rates are going to compress further, and get even more expensive just because the debt's so, cheap, that if you can buy something kind of that mid-4 cap rate and borrow money at 3% and lever it, 4-to-1, 5-to-1, I mean, you're going to walk in at 8-9% cash on cash pretty much out of the gate. So that's kind of what we're seeing. So I think the market pricing is gonna go up, or cap rates compress. And kind of to your opportunity, do a blind pool kind of opportunistic type fund. We never have done that. We've always, like you mentioned, do deal specific equity raises. We never really had a problem getting funded. So I've kind of been in the mindset, it's not broken, why go fix it? So we've had the incremental step over the last 8 years, doing a $2 million raise and a $3 million raise and a $5 million raise and 10. And then now we're pushing $30 million in single equity.
Yeah, that's
tranches.
Amazing.
So
that's amazing.
Why mess it up? And it's a lot easier from putting my investor cap on. If I'm a limited investor, which I am in other people's deals, it's much easier to understand, like, hey, this is the location of the asset, here's a specific business plan, versus some broad kind of strokes of, hey, this deal might look like this and your ranges will return between here and here.
Sure.
So we've always just chosen kind of keep the philosophy, if it's not broken, don't try to fix it. And I think at this point, once we get in the next post-COVID deal, which will be our first post-COVID deal done, I think that I might have the confidence to even grow that, depending on kind of the demand that we see, whatever that deal is, whenever that deal happens.
Okay. So the last question I have for you, Michael, and this has been interesting, and I appreciate your time. What advice do you have for rookies coming into the marketplace? Over the last 6 or 7 years, I kind of follow how I get my business, and it's usually 2-to-1. I get 2 deals from existing clients for every 1 deal I get from a rookie. And I haven't found that that's changed in the last 6 months. We're still getting new people coming into the market, which is great, because that's how I grow my business. What advice do you have for rookies?
I think really a few things. I mean, one is it's amazing how much of an exponential business this is. Going from 0 to 1, doing your first deal is really, really hard, but going from 1 to 2 is exponentially easier. It's probably 8 or 10 times easier to do your second deal than it is your first deal. So I think, focusing on getting that first deal done.
Get that first one done. So right. That when the investors ask you, hey, Michael, have you done this before? You say, hell yes, once.
Yeah. That's right, once, but that's it's a relative business too. It's all relative. If I've done 1 deal, you've done 0, I'm 100% more experienced than you are, right? So, just knowing that once you get that first deal done, you can really if you're done with care and caution and, being respectful to the investors, you could really grow exponentially. Like I said, in an 8-year period, it went from raising 2 million to 27 million, so almost 15 times the equity raise in an 8-year period, which is pretty amazing. So, doing that, always keeping in mind on your investors, because your investors are your lifeblood. So you have various stakeholders. So trying to be, a good steward to all your stakeholders. So whether that's your investors' capital, the bank who's loaning you money, your management team, your internal employees, making sure that you're having care and respect for everyone along the way. And if you take care of all those people, this is a business where you can do more and more. The people that are kind of coming this and have that win-lose mentality, I win, you lose, tend to not be as successful in this business. There's many stakeholders, plus all the vendors, your lawyer, your accountant, your real estate brokers, all those people as well are, integral parts of you being successful in this business. So I think taking care of that, and if you have a good reputation among all those people, it's amazing how much more business you're going to do. And, one of the things we really focused on when we did our first, handful of deals, probably first 5 deals, we didn't really make that much money. I mean, we certainly made money, but our splits weren't as high, our fees weren't as large as what we could command today. But really what I was focused on, Gene, was getting a track record and getting the reputation of Michael Becker in the Texas marketplace, being away from being a lender to being a principal in these deals. And if you go out and do, 4 or 5 deals and 1,000 units in a relatively short period of time, like I did, it doesn't take very long for your reputation to kind of solidify. And then once I have a little bit more track record, and especially once you kind of go full cycle on a deal or two, you can probably justify more market rate compensation. So if you're really looking to go, maybe not being quite as worried about the first deal or two, that what your split is going to be in the deal, just making sure you do a good quality deal and deliver results. So, that's a fine line to walk, because I know you always say, you need to make sure that you do have proper compensation in there, because this, if you hit by a bus, the person can take this deal over, needs to be paid to take these deals on and manage them for you. But, there's certainly a spectrum on what you can charge, and being on the more investor favored when you start out is probably something I would recommend. And then you can always make more money on the next deal or the next deal, up to the point where it's kind of fair compensation, kind of more market rate compensation, which is what I think, we try to focus on.
Good. Well, that's good advice. I appreciate your time today, and good luck to you. I'm waiting for your next deal to come in so I can work with you again. I'm going to sign off. Thank you, Michael, for everything you've done, and I'll talk to you later.
Thank you.